the ones that feel safe at the time. Today we're going to walk through 5 retirement mistakes retirees didn't see coming until it was too late. The goal is not fear. The goal is awareness. Because awareness gives you options. The first mistake is underestimating healthcare costs. Most retirees plan for insurance. They enroll in Medicare, maybe add a supplement, and assume they're covered. On paper, it feels manageable. But what many didn't anticipate were the out-of-pocket realities. Dental procedures that aren't covered. Hearing aids that cost thousands. Vision care. Prescription tier changes. Specialists outside the network. And then there's long-term care, the expense that quietly reshapes retirement plans overnight. Healthcare inflation has historically risen faster than general inflation. What costs a few $100s today can become thousands over a decade. Retirees often say they planned for premiums, but not for cumulative exposure. It only takes one diagnosis, one fall, one extended recovery, and suddenly the retirement budget shifts permanently. The second mistake is claiming Social Security too early. This is one of the most common regrets. Many retirees file at 62. Sometimes it's fear that the system won't last. Sometimes it's because a friend did it. Sometimes it feels like, I've worked long enough, I deserve it. What they didn't fully absorb at the time is this: claiming early permanently reduces your benefit. Not temporarily, permanently. That reduction compounds over decades. It affects spousal benefits. It affects survivor benefits. It limits flexibility later in life when medical costs often increase. For someone who lives into their late 80s or 90s, that early filing decision can mean tens of thousands of dollars in lost lifetime income. The paperwork takes minutes to submit. The consequences can last 30 years. The third mistake is keeping too much money in cash. After decades of working and watching markets rise and fall, many retirees crave safety. It feels responsible to move heavily into savings accounts, CDs, or money market funds. And emotionally, it feels secure. The problem is inflation. When inflation rises, purchasing power falls. A portfolio that isn't growing at least modestly can slowly lose ground every year. Retirees often say, I didn't lose money in the market. But when adjusted for inflation, they lost purchasing power quietly. The fear of market volatility led to a different kind of risk, longevity risk. Outliving assets not because of bad investments, but because of insufficient growth. Retirement can last 20 to 30 years. A portfolio needs to work during that time, not just sit still. The fourth mistake is helping adult children too much. This one is emotional. Many retirees want to help. It's natural. Co-signing a loan, helping with a down payment, covering emergencies, funding grandkids' education, allowing adult children to move back home. None of this is wrong in principle. But what retirees didn't always anticipate was duration. A temporary assist can become ongoing support. Financial dependence can stretch years longer than expected. Every dollar given away early in retirement is a dollar no longer compounding for future needs. And when unexpected expenses arise later, that generosity can create strain. Some retirees admit they felt uncomfortable setting boundaries. They didn't want to say no. But later, when their own resources tightened, it became much harder. Retirement requires protecting your own stability first. Helping family is admirable, but it cannot come at the expense of your own long-term security. The final mistake is believing expenses would go down. This is one of the biggest surprises retirees report. They assumed no commuting costs, no work wardrobe, no payroll taxes, a simpler life. But retirement often introduces new spending categories. Travel increases early in retirement. Dining out becomes more frequent. Home renovations finally happen. Hobbies cost money. Insurance premiums rise. Healthcare costs grow. In some cases, retirees actually spend more in the first decade than they did while working. Expenses don't necessarily shrink, they change. And without careful monitoring, those shifts can gradually erode savings faster than anticipated. Now here's something important. None of these retirees was careless. None of these decisions was reckless. Most were based on reasonable logic. That's what makes them dangerous. Retirement planning is not about predicting every future expense perfectly. It's about building margin, building flexibility, and revisiting decisions regularly. If you're approaching retirement, ask yourself, have I stress-tested my healthcare projections? Have I evaluated different Social Security filing scenarios? Is my portfolio positioned for both stability and growth? Have I set clear financial boundaries with family? Have I mapped out tax-efficient withdrawal strategies? Do I know what my first 5 years of spending may realistically look like? Retirement security is not built on perfection. It's built on awareness and course correction. If any of these 5 mistakes made you uncomfortable, that's not a bad thing. Discomfort often signals an opportunity to prepare. The worst retirement mistake is assuming everything will work out automatically. It won't. Retirement can be stable, it can be secure, it can be fulfilling. But only if you approach it with clear eyes, realistic assumptions, and the willingness to adjust when needed. That's how you protect not just your money, but your peace of mind. And that's what truly defines a smart retiree.